Hi and welcome back. In today's video, we're going to be talking about payday loans. What are they? How do they work? Why you might want to think about it before you get one. So let's get started. What are payday loans? Payday loans are short-term loans that usually have to be repaid within about 2 to 4 weeks. Basically, the next time you get paid, hence the name payday loan. Usually they're for small amounts, about a couple $100s. They're not available in all states. For most states that do allow payday loans, you're capped at about $500, but there are some exceptions like Oregon, you can go up to $50,000. Now, these type of loans are generally for really unexpected expenses like small medical bills, you're short on a check, etc., and you're just trying to cover it. And again, in most states, it's for a small under $500 amount. However, these type of loans come with really high fees, and that's usually why they can trap person into a cycle of debt. How do payday loans work? So to get a payday loan, typically you have to go and fill out an application. You're going to submit either bank statements or copies of previous checks, so that way the payday loan company understands roughly how much do you make and what's a max amount that they can lend to you. If you are approved, then the lender will distribute the amount that you requested or you were approved for directly into your account. Then on the due date, the lender will then withdraw the amount that you agreed as the repayment. Why should you be careful before you borrow with a payday loan? While payday loans can be a convenient way to get cash quickly, especially in times when you are stressed and feel like you need that money, they usually come with really high fees. For example, let's say that you want to borrow $500 and the payday loan company approves you and tells you you're going to have a finance charge of $25 per 100. So when it is time for you to pay back that $500, you're actually paying back $625 because $25 per 100 borrowed, and if you borrowed $500, 25 times 5 equals 125. So again, your grand total being paid back is $625 for the $500 that you borrowed. At first, people go, oh, this is doable. And then they find out that life circumstances happen and maybe their next check will cut them short. Or because of that amount, they will be short the next time, and then they go back into a deficit and then are put back in a position where they need to do this again. What happens if you can't pay? Well, if you can't repay the loan back at the time that's specified, sometimes these loan companies will allow you to roll it over, and then they attach additional fees and you can keep postponing paying back. But you're again adding fees and interest to your original loan, and it can balloon really, really quickly. So what is the APR on a payday loan? Well, congratulations on knowing what an APR is, which is annual percentage rate. Let's do the math to figure it out. This is based off the example that I used just a little bit ago, which is that you borrowed $500 with a finance charge of $25 per 100. So now 25 of 100 is 25%, but we're talking about annual percentage rate, which means we're going to have to do a little bit more math than that. So in order to figure out the annual percentage rate, you need to take the interest charge and then multiply it by the number of periods. In this example, we were thinking about bi-weekly payments, so you get paid every 2 weeks. So if there's 52 weeks in a year, that means there are a total of 26 payments in that year. So now we're going to take 25, because it was 25%, 25 of 100, and then we multiply that by 26, which means that for that payday loan, it had a APR of 650%. That's an extreme amount. Alternatives to payday loans. Well, if you're ever put in a position where you are considering a payday loan, there are some other options out there, but it also depends on your personal level of confidence in engaging for these type of things. Your first option is, if you have an employer, you could potentially ask your employer for a payment advance where they pay you more money and then take it from your paycheck. Usually there is no interest charge with this, and it can sometimes be done and sometimes not be done, but you don't know until you ask your boss. Your second option is that you can try to borrow money from a friend or a family member, and that sometimes can also be a really hard pill to swallow, saying, hey, I'm going to come in short, will you do me a favor? A third option, which is something that a lot of people get really scared about, is using a credit card to make up for the deficit, because although credit cards can have high rates, say 25%, and that's the APR, is still less than 650%. So that's something to consider, and always figure out a plan to pay it back so that way you know that you'll be covered. Just a quick summary is that payday loans can be risky and an expensive way to borrow money. If you have other options, try to go for those other options first. And also, it's dependent on your state. You might be in a state where a payday loan is not even an option. If you are considering a payday loan, please make sure that you read all the terms before agreeing to it. There may be extra stipulations that could save you money or harm you in a further way. Well, that's it. If you have any other questions, please leave a comment below. More than happy to answer them, and I hope you have a great one. See you in the next video. Bye!